This is Mike Lingle from Rocket Pro Forma, and today we're going to talk about cost of goods sold, or COGS, cost of goods sold. So let's dive right in. So in a traditional business, the cost of goods sold is what it costs to create the product. So when we look at this packaged toy, it's the raw materials that go into the toy and the packaging, the labor to manufacture and finish, putting the toy inside the package, and then shipping everything to your warehouse. And that's kind of the traditional cost of goods sold. It's not the cost of delivering the product to the customer. And the sorting question for is it cost of goods sold or is it COGS, would we have had this expense even without any sales? So we would have still created all of the toys and the packages and taken them to the warehouse. They just never would have left the warehouse. I'm not an accountant, so for any specific questions about what is COGS, definitely go talk to your accountant. But what is not COGS usually is logistics and fulfillment, so getting the product to the customer, not packing and shipping to deliver to the customer, usually not credit card charges unless credit card charges are core to your business and every customer pays the credit card charge. So a lot of virtual, like eCommerce or software as a service, those may be able to do their credit cards as COGS. Again, I'm not an accountant. Cost of goods sold for virtual is a little bit different. It's the onboarding and customer service, it's the hosting costs, and maybe the credit card charges, as I mentioned. But what it's not the software development, strangely. So it's a little bit different than a physical product. And we sometimes say, for virtual businesses, we sometimes say cost of sales for virtual goods and services rather than cost of goods sold. Because there are no goods, so we just say cost of sales. And so let's look at unit COGS. We'll go for the physical first. And we talk about the landed cost. So it's the per unit cost of creation and delivery to your warehouse, at which point the product is landed in your warehouse. So that's why we call it the landed cost. So here's an example. This is an IoT device. It has a retail price of $249 and a $90 landed cost. And that landed cost is actually the COGS in this simple model. So first, we want to calculate the gross profit, which is a dollar value. And the formula is the gross profit is equal to the revenue in dollars minus the cost of goods sold in dollars. So using that formula, revenue minus cost of goods sold, what is the gross profit for this product per unit? So we take the revenue, we subtract the cost of goods sold or the landed cost, and what do we get? That's right, we get $159. So that's the gross profit on each unit that we sell in this business. From the gross profit, we can calculate the gross margin. So the gross profit is a dollar value, the gross margin is a percentage value. And the formula we use here to get that percentage is the gross profit in dollars divided by the revenue in dollars. So we're going to show the gross profit as a percentage of revenue to get the gross margin. So here, if we take that $159, so we know that the cost of goods sold is $159 here. Get out your calculators. What is the gross margin going to be? Again, we're going to divide the cost of goods sold, that $159, by the retail price. So when we divide $159 by $249, what's the answer? 64% gross margin. And that 64%, that $159, that 64%, that's the money we have left over in order to pay our operating expenses and hopefully have some profit left at the end. I do a separate video on unit economics, so we can go a little bit of a deeper dive into how that works. But just understand the gross profit, the gross margin, those are expressions of how much money you have left to pay the operating expenses and hopefully have a profit after creating the product. So again, the gross profit is how much money you have left to operate your business. And so if we look at the income statement, remember this is our template, you will see revenue and then cost of goods sold and then gross profit, gross margin, and then the operating expenses, and then the EBITDA, which is an expression of profit or loss. And you can see we have the revenue, we have the cost of goods sold. We subtract the cost of goods sold from the revenue in order to get $26,000 of gross profit. And then from there, we can calculate that we have a 54% gross margin. So the math is actually really easy once you get the hang of it. And just remember, because of accountants, we have a few different types of expenses. Cost of goods sold is one type of expense, which is creating the product or service. And then operating expenses are what it costs us to actually run the business, acquiring customers, paying rent, insurance, lawyers, all that fun stuff. And so this is a quick primer on cost of goods sold. I do some deeper dives in other videos, but this gives you kind of the orientation. And again, the math is pretty simple once you get the hang of it. Thanks so much.